Thank you, Peter. I'm delighted to introduce Ed Clark, the CEO of TD Bank Group. He has local roots, having earned 2 Harvard degrees, but then again, who hasn't? Actually, I haven't. And we are very glad that he's back here today. TD Bank has been a strong partner of the Celtics for 6 years, recently renewed, thank you, and has distinguished itself by choosing to focus with us on some of our most disadvantaged communities. And by the way, they renamed our arena here in Boston, and now both the Celtics and the Bruins have won championships at the TD Garden. That is cause and effect. Under Ed's leadership since 2002, TD has doubled its customer base, its retail network, and its workforce, and its assets and deposits have more than doubled. The United States has been absolutely key for them. TD is now one of the largest banks in the U.S., driven in part by Boston, very strong performance here in New England. It is ranked one of the strongest banks in the world by Bloomberg, and most recently, Barron's named Ed one of the 30 best CEOs in the world. As I can attest, TD's success is sustained by straightforward, simple philosophies, long-term relationships, customer needs, standing by customers in bad times, as well as good. We lost 16 games in a row at one point, and Ed wrote me a sharply pointed note, but he was still standing next to me. He looks at leadership as a challenge to set others up for success and remain optimistic. His approach is obviously one worth studying. TD has always promoted discussion and debate around important issues in its communities, and today is a perfect example of that. You've undoubtedly heard people say a crisis is a terrible thing to waste. We can create opportunity from adversity. In Ed's view, as you will hear, there's no better time to build a better banking system in America. He's going to suggest a way forward for all of us and also speak about the global economic crisis and hopes for recovery. So please help me welcome Harvard alum Ed Clark.
Well, thank you. Thank you, Wick. I got a chance to go out this morning and tour the thing and look at all the great pictures in the history, and I must say I was a little jealous when I did that. Personally, it's just great to be back here in Boston. This is a very special city for myself and for my family. I spent some great years at Harvard, if that doesn't bother some of the people in this room. And in terms of the sponsor, I can say my one connection is that my wife went to Boston College and graduated from Boston College, so I can say I married a Boston College girl. As I said, Wick showed me around his premises and then looked at some of those pictures. And I have to say that across there you could see the TD Garden, and nothing makes someone from TD more proud than to see the TD logo against the garden. We were kind of hoping that we would be seeing 2 teams for a while with that, but I think we're now counting on you to make sure that we see that logo all the way to the end of the playoffs here. It's a little hard, in my position, for a guy from Toronto to have to root for Boston and Celtics, but if you're from TD, it's a little easier to do that. Now, I think many of you would know us as TD Bank, America's most convenient bank, which we clearly are, but we are more than that. We are one of the world's largest financial institutions with total assets of $775 billion. By market capitalization, TD is the 7th largest bank headquartered in Europe and in North America. To give you an order of magnitude of earnings, in 2011, our total earnings were $6.3 billion. They had grown 20% in 2011. And today we employ 85,000 people. A third of that 85,000 is here in the United States of America, which, as Wick mentioned, has been an enormous focus for us. And we're particularly proud of our team here. Mark Crandall and the team have just done an incredible job of putting us on the map in northeastern United States. In terms of the U.S. and in Boston and Massachusetts area, we rank 4th in terms of deposits, and we employ about 2,300 people in the state of Massachusetts. And we have more than 150 what we call stores. Some of you might call them branches, but we call them stores, reflecting our sort of retail focus. And we go from Barnstable to all the way to Berkshire County. And we are a firm, as a bank, that believes you should constantly grow your distribution network, and we will add another 5 stores this year. And if you've got some sites, I'll mention it. We'll come talk to me afterwards. We'll do some business here because we believe in growth. We believe that if you want to run a great company, you have to continue to grow. Now, how have our shareholders done as a result of some pretty spectacular growth, which Wick mentioned? Well, since 2002, and I just happen to like that date since that's when I became CEO of the bank, TD's share price has increased by more than 2.5 times in that period. And that was driven by compounded annual earnings growth of 18%, including all during the period of the financial crisis, and earnings per share growth of 14%. We delivered the best total shareholder return of all large banks in North America, Canada, and in the United States. Now, the financial crisis changed a lot. And tough times, though, for us, has helped us be able to stand out against the competition. In 2007, there were 9 major banks on the New York Stock Exchange that were rated AAA by Moody's. Today, there is only one, TD Bank. Since 2007, when you think the crisis started, our shares have actually grown in value by 40%. The best of all major banks in North America, Canada, and the United States, significantly higher than U.S. banks. The best bank in America in that period, share price has fallen by 12%. And not only were we able throughout the crisis to continue our dividend, we have over the past year and a half increased our dividend 3 times, twice in 2011. I think a very powerful statement not only of our underlying earnings power, but our confidence in the future. So today I'd like to talk about a couple of things. First, the economic recovery, and more specifically, what kind of direction do I see the economy going over the medium term? And second, bank reform, which in my view is not only critical to the long-term prosperity of every American, but frankly, America is critical to long-term prosperity of the Western world. So let's take a step back and look at how we got to where we are today. The world has been through quite a journey. It's hard to believe, frankly, that it was 5 years. It's been 5 years since the housing crisis started, which in a sense led to the financial crisis in the world. In the decade that preceded that, we had apparent growth in the United States, fueled by low interest rates, low taxes, combined with big government spending and very large deficits. Additionally, frankly, loose regulation in the housing markets and active pressure by politicians and government agencies to promote housing ownership produced a classic asset bubble. At the same time, the relaxation of financial regulation and, frankly, a complete lack of self-discipline in the financial sector created a set of financial institutions that ballooned in size and shifted their business model from serving the customer to trying to make money by speculating. And what's more, they frankly lacked the capital and liquidity to underpin the very risks that they were taking. In Europe, the creation of the euro produced very similar conditions. Countries in Southern Europe got, in effect, a free pass. They could borrow at German interest rates. They could run large deficits. They could encourage a housing boom. And there appeared to be no market constraints on their actions. European regulators appeared to see their role as supporting their national champions rather than actually trying to restrain these excesses. Well, we all know what the end result of all this was. A financial crisis that wiped out the net worth of many, many people, and they left governments around the world heavily in debt. It also destroyed a whole foundation of public trust in both governments and in the financial industry. Now, the reaction from governments, particularly led by their central banks, was, in my view, decisive and directionally correct in the initial stages. Washington's immediate response to the weakness in the banks was frankly impressive. Their stress tests and the recapitalization programs went a long way to restore market confidence. By being tough and transparent, the United States was able to take advantage of its huge asset. It has the best capital market system in the world to rapidly recapitalize its banks. Europe would be in a lot better shape today if it had followed the American example. Still, America has suffered a balance sheet recession, from which, frankly, there will only be a slow recovery. Whatever people may tell you, history shows there is no codeine-laced antibiotic to quickly cure this patient. It frankly takes time, and it will involve ups and downs. Global imbalances remain. Well, China has shown some willingness to appreciate its currency, not significantly. And this means that the current account imbalances, which are one of the key burdens in the society, all that burden of adjustment is actually being shifted onto the U.S. and requiring U.S. domestic policy adjustments. Given the magnitude of the shift to cure those imbalances, this is frankly going to take time. Now, things are starting to feel better than they did 6 months ago. But it is important to remember that the fundamentals actually haven't changed. The European Central Bank's liquidity injection did make a major easing of the sovereign debt crisis, but left the tail risk in place. In fact, just punted the tail risk forward. Half of the Eurozone is in recession, and the other is facing anemic growth. And frankly, slow growth is going to make it even harder for governments to address their fiscal problems. And just when we thought, well, maybe we've solved the problems of Greece, it's apparent the problems are emerging in more major countries, such as Spain. The bottom line is that the euro, frankly, is probably a flawed construct. The difficulty is unwinding it has enormous complexity. Regional imbalances have to be cured, but they can't be cured through devaluations. It means you have to get nominal wages to really drop in a whole set of societies, and history tells you that is a very, very difficult thing to do. Moreover, the current austerity drive, which is the dominant theme in Europe today, while it's absolutely necessary to cure the sovereign debt issues, absent any other measures, risks confining Europe to a very long period of negligible growth. Now, let's come to North America. Things look a little better here. The United States survived a major ratings downgrade last summer and a pretty dysfunctional debate around raising the debt ceiling. I believe the United States economy is gaining some traction. The private sector has clearly been creating jobs all during this period. And I think consumer and business sentiment is moving and improving. And while housing prices have gone down and continue to creep down, 1 month it may go up a little and then down again, I think there are indications that we're reaching a bottom, that this market is bottoming out. And I think what all of this does is underscore the incredible resilience of the American economy. But the evidence, as I always say, the mood may be there, but the facts aren't that much different. And the fact that the Fed continues to say we're going to keep our interest rates low for as long as the end of 2014 tells you that they believe there's significant slack still in the economy. And of course, there's the dreaded risk that at the end of this year, the GDP may take a big hit because there's a variety of tax incentives that may not get renewed. And the policy environment in the United States today, particularly given the election, is not constructive to try to find the natural compromises that you'd think you would have. In Canada, America's largest trading partner, we've had some very good employment reports. I'd say the difficulty in the Canadian side is more what's happening to the consumer and their debt levels. Household debt levels are at record high. And while we don't believe that there's going to be a crash in the housing market, we do believe the housing market is going to slow down. And that, frankly, given our history, is a good thing. But it is going to put downward pressure on consumer demand and therefore downward pressure on the growth rate of the Canadian economy. When you add to that the very high value of the Canadian dollar, I think you have to look at Canada, that Canada will no longer outgrow the United States in either real or nominal terms. So putting all of it together, what does this mean? I would say don't expect a snapback recovery. The best we can hope for is a consistent, steady recovery accompanied by paced structural reforms to deal with our fundamental underlying structural issues. Now, this is not a perfect scenario, but it is an environment where well-run companies, including financial institutions, can continue to do quite well. Now, obviously, the financial crisis set in motion a catalyst to have bank reform. Nobody wants to see banks blow up again. And I believe we've made substantial progress in building a stronger and safer financial system. But if you read the papers, there's some pretty significant tension between bank leaders and policymakers on whether we've got the right mix of policy. So if you're going to have common purpose, it's useful to have common ground. And so I'd like to suggest some basic principles which I would think, whichever side you're on this debate, you could agree on, and it would be a basis in which you would get future reform. So the first principle, and I think a very important principle that the private sector, the leaders of the banks have to stand up for, is governments should never have to bail out a bank or any other major player in the financial industry. Secondly, instead of being reactive, bank leaders should proactively support the principles of reform, and if they don't like the suggestions they're getting, they should suggest more effective means to implement the key principles of reform. And third, bank leaders should champion a shift in the industry, a return to the industry's focus on what I like to call old-fashioned banking. Banking that's actually directed to a set of activities that actually help to grow your country and the communities in which you operate. So let's take a look at the first principle. Banks must have a capital structure that makes sure that taxpayers and depositors are not on the hook if banks fail. That's what a capitalist system is all about. Let the shareholders and the bondholders assume the risks and rewards of private enterprise. The good news here is that major countries have agreed on a set of rules to strengthen capital and liquidity requirements. Called Basel III, these tougher rules will also drive much of the speculation game out of the bank securities arms. Chairman Bernanke described Basel III as essential for the stability of the financial system. I completely agree. And while there are lots of small changes that we would have liked to have in the rules, as a package, TD supports Basel III and these requirements. Indeed, we have already met all of these requirements on an accelerated basis. Unfortunately, there still remain bank leaders who want these requirements reduced or stretched out. They see their reforms as a threat to their existing business models. Well, I would argue that's exactly what the reforms are meant to achieve. There was too much non-value added activity in the banking system. Provided there is a level playing field, and by that I mean a common set of standards of quality and level of capital and liquidity, the new capital rules will cause a shift in business models and force banks to reprice products to carry their true costs. Now, I'm sympathetic to those bankers who say, well, I don't know where they're going to have a true level playing field. That's where their focus should be on, not on reducing the standards. And I think they should look to the Financial Stability Board because they are trying to play a very strong role in ensuring consistency of implementation. Now, resistance to Basel III raises in my mind a much greater issue. Frankly, when you resist that rule, you're providing an open invitation for regulators to add more rules then to protect the system because it doesn't have adequate capital and liquidity. And that inclination is further driven by populist sentiment that for a variety of reasons would love to micromanage the banking sector. And that combination has led for us to in fact drive a set of interventions that have exacerbated what I see as America's already excessively rule-based system, a system that values process over content, details over principles. Bankers and regulators are increasingly encouraged to check boxes, fulfill requirements, rather than to step back and say, what should we as leaders be doing to strengthen the financial system? What makes this worrisome to me is the atmosphere it creates. What happens when you do that, when you focus on process, effectively it gives bankers a free pass on what's right because there already are prescriptive, detailed rules. Organizations then get focused entirely on meeting the rules. As long as it fits, do it. But what if it's not appropriate? That should be the true test. These changes increase real risk because they take away energy from the things that really matter to managing your risks and protecting the consumer. Boards of directors should be asking questions about strategy and the real risks the firm is taking. Instead, if you look at the average bank board today, they are bogged down fulfilling compliance requirements. I believe that if we supported and adopted Basel III, this would help assure governments that they're not going to be exposed to risks ever again. And that would allow them to step back and encourage lawmakers to say, well, let's separate the regulatory wheat from the chaff. And let's actually talk about how we can make the banking system more effective and more efficient. And this would frankly include better coordination between the United States and other international bodies, and frankly, dramatically less competition between regulatory agencies within the United States. The financial crisis has made it absolutely clear that globalization is not a concept, it is a true reality. And so you have to look at the financial system as a whole. It matters to take a holistic view is even more important. And regulatory competition, whether it's within the United States or between national regulators, does not make, in fact, a safer system. For consumers, there's another reason to be concerned by this growth in microregulation. To the extent that Congress passes populist laws that then in effect are attempts, frankly, to reduce banks' revenues or that add significant costs to how it costs to operate a bank, the reality is that banks will over time look for ways to replace those lost profits or pass on those extra costs. That's what happens in a capitalist system. And so it's often the consumer that ends up bearing the brunt of microregulations through higher costs and fees. There are countless examples of how this has happened in the last few years. Now, some people would say, well, higher consumer costs are just the price we pay for a sounder and safer system. I don't think that's true. There's simply no proof that a prescriptive regulatory system like the one that exists today in the US is any safer than any other system. Compare the American system to the Canadian one. Canadians use a risk-based approach set in principles. They impose tough capital standards and tough mortgage rules. Canadian banks hold all their mortgages on their balance sheet, so they have skin, so they care about the strength and validity of those mortgages. What happens when you do that is the principled approach creates an atmosphere where bank leaders like myself understand it's my job to protect the long-term interests of the institution, its customers, employees, and shareholders. There are no excuses. If you get your bank into trouble, you can't just say, hey, I was just following the rules. Now, I believe a lot of credit goes to our chief regulator, Julie Dixon, who's championed this model, not just in Canada, but around the world. Ironically, there are going to be pressures to change that system. Right now, when you look at the experience of Canada, I'm not saying that Canada's system is perfect. Far from it. Leading up to the financial crisis, bankers and regulators made mistakes, we missed things, we had losses. But in a principle-based regulation system, while the players are given enough latitude that they can make judgments and they can make mistakes, if they've got the right capital and liquidity rules, then that does not mean those losses are going to result in bringing the banking system down or a bill given the Government of Canada. The Government of Canada did not put a single dollar in a single Canadian bank during that crisis. So in Canada, we were able to weather the storm in some sense, arguably, as the best country in the world. I'm not arguing our system is better. I'm just arguing there's no evidence that prescriptive rules made the United States better. And so why not have a system that, in fact, has turned out to be more effective? Ironically, Canadian regulators are now under pressure from the rest of the world to change their model. Because as regulators look and try to make this level playing field in the global banking system, they look at Canada and say, well, you don't have all these prescriptive, detailed rules the way we do. So you should get on board here and start to follow a more American-style system. I'm hoping and I'm confident that our chief regulator is going to resist those pressures. Now, I'd like to talk about then the second principle, was supporting effective change by bankers saying, why don't we agree on what needs to be done and why don't we lead the charge? Bankers should acknowledge and support, I think, the core principles around perform. And they should suggest pragmatic ways, not dogmatic ways, to achieve it. Let me use an example that's been in the newspapers, the VOCA rule. In my view, and this isn't a view obviously universally held in America, VOCA's core argument is absolutely right. Many in the industry did lose their way. And while there are many great banks in the United States that stuck to their knitting, many obviously did not. They began to look at clients, not as clients, but as counterparties, instead of substitute a view that says, well, let's the buyer beware. And we've all heard people talk, quotes where they actually clearly described it as that. Now, what's happened here with VOCA is, though, that the regulators overreached in trying to write these regulations to implement VOCA, turning a simple principle into a legal labyrinth. Frankly, and I think this is a very positive sign, the Fed has responded and has now postponed its implementation date. The risk is that by having overreached in writing the rules that they've damaged the support for VOCA, because the spirit of what VOCA is saying is right. Banks should not be hedge funds. Their mission has to be to do things that add value to the economy. They do not have the right to put the taxpayer at risk. If you want to speculate, do so in an institution which everyone will allow to collapse and let the shareholders and creditors pay the price. Don't go into the banking business. But equally, I don't think we need countless pages of regulation to get this shift. As I mentioned, if you actually look at Basel III, and we had implemented Basel III aggressively, you're going to drive many of these activities out of the banks. And you force bankers to look at their activities that survive, and then they can turn to the regulators and say, okay, now which ones of these activities that are actually now economic really do concern you from a safety and soundness perspective? And then sit down and say, can we work together to figure out how we can limit your concern in this area? I think as a general rule, don't try for perfection. What we're really trying to do is reshape the industry away from being a betting organization to one focused on the client and the customer. I think key is to develop a productive working relationship between the industries and its regulators, enabling both parties to agree in the principle, and then say, well, how can we get that goal in the least intrusive way? Now that leads me to my third principle, is how do you return the industry to what it used to do, the old-fashioned banking. Banking that's built around the customer, meeting their needs, building long-term relationships. It covers the entire spectrum from personal banking, small business, commercial, wealth management, and corporate banking. It promotes a great tradition of what were great securities arms that actually built their business through helping others grow their business through their acquisitions or financing. That is the heart of TD's strategy, just to be an old-fashioned bank. We view our clients as long-term partners. If we look after their interests, TD's going to do all right in the long run. Not every banker thinks that way. I've constantly told stories of bankers who love to be your bank when you don't need them, and they don't want to be your bank when you do need them. And we have been forced through the organization culturally to say, let's always take the opposite view. Throughout the crisis and the downturn, TD Bank was the only large top 10 bank in the United States to grow its lending every single quarter. Good business, good partnership, and great for the economy. And we do that because we have a view on risk. We only take on risks that we can understand and we can manage. And we do not believe that we should compete on risk. Compete on risk management, but don't compete on risk. And that means that you'll avoid the big blow-ups, and then that means you can be strong when you're needed. Well before the crisis started, we drove in some very simple but very powerful principles. If something's too good to be true, frankly, it probably is. And you should walk away from it. Don't do it or don't sell it. Walk away from opportunities. As I say, be the first person off the dance floor, not the last. And because of that, we don't make bad loans in good times. So what does that mean? Is we can make great loans in bad times. Our disciplined approach has meant making tough decisions, and this is the hard part, like refusing to do subprime lending in the United States. These decisions mean you have to give up short-term profits. But we have learned if you do the right things for your customers, you'll do the right thing for us, and you'll do the right thing for your shareholders. As it turned out, by walking away from those risks and those profits, we avoided the losses that other banks incurred, and this put us in a position to grow rapidly and take profitable market share. Now, we also believe very firmly that we're retailers. And so we work hard at living up to our reputation as America's most convenient bank. And that means compete every single day on service. We're open longer than our competitors. We offer 7-day banking. We're always looking, as I said, for more convenient locations. As other banks last year shrunk their footprint, we opened 37 stores in the United States. We want to open the same number this year. Being convenient means making it easier for the customers to do what they want. Look at checking fees. A lot of banks, as you know, make their disclosure policies as complicated as they can be, requiring customers to sift through hundreds of pages of legalese. We use a simple one-page form, recommended by the Pew Charitable Trust, that's simple to read and simple to understand. We know that our long-term success depends on the communities in which we operate. If they do well, we will always do well. And that's why we champion diversity and equal opportunity in America. For the third consecutive year, the Human Rights Campaign Foundation has recognized TD as one of the best places to work for lesbian, gay, bisexual, and transgender equality. We invest millions of dollars in affordable housing. Our financial literacy program, run by our employees, has helped more than 1 million American students. In Massachusetts, the TD Charitable Foundation has awarded over $1.5 million in grants last year. And as part of our efforts to green urban centers, employees organize tree plantings that help make communities in Boston more livable. Now, this is part of a larger commitment we want to be the leader in the environment. We were the first major bank in North America to be carbon neutral, and we are now launching a similar initiative to reduce our paper consumption and to protect forest habitat. At the end of the day, I believe that good old-fashioned banking, which is about creating wealth and prosperity for the communities and customers, ends up creating wealth and prosperity for our shareholders. So to sum up, the global economy does look and feel better than it did last summer. And this is especially true in North America, not so true in Europe. But there are still fundamental challenges, and we must not expect this recovery to sort of unleash some great pent-up demand from consumers. It just isn't there. The recovery has got some traction, but it's going to be slow-moving and may have some stops and starts along the way. I believe a sound banking system has been shown to be a critical element in how economies recover, and they do influence any economy's long-term prospects. America has the opportunity to take the crisis to build a better banking system. It should insist that banks carry enough capital and liquidity so that they never have to rely on governments ever again. But it also needs an effective and efficient regulatory system that shifts the burden from the regulators to the bankers to do the right thing. Micro-regulation, in my view, has a corrosive effect on the system. Consumers pay more, and banks are forced to dedicate more resources in areas that have nothing to do with making institutions safer and sounder. Surely we can reduce risk and red tape at the same time. Banks, in turn, must focus their activities on their people, on their customers, and help them save, invest, buy homes and cars, and help build businesses to raise money, or make acquisitions and grow. And for all that to happen, you've got to have perspectives to change and positions need to shift. No small feat in a big society where people are locked into their positions. But the great thing about America is that America always rises to challenges. That's been this country's winning formula. And that's why I'm optimistic that we can find that common ground and move forward with common purpose. Indeed, we must, for the good of the industry, but more importantly, for the good of the country. TD has just huge faith in America. That's why we've invested so heavily here. Yes, America suffered a tough downturn. Yes, it's going to be a long recovery. But America will recover. It will remain the most important economy in the world. Why is America so exceptional? It's because Americans invent and they innovate and they build things. They dream about better tomorrow. They insist on demanding a better life for their families and their communities. TD Bank, our bank, its future is bound to this very energy and spirit, and we're incredibly proud of our relationship. We promise you we are going to keep investing in America. We are going to stand by America. We're going to create real value in the greatest economy in the world. Thank you very much.
Thank you, Ed. I think we have time for, as usual, a couple of questions. There are microphones in the audience. Please wait till you get a microphone before you start asking your question of Ed.
Thank you for your very thoughtful observations, and congratulations on your corporate strategy and success. A breath of fresh air. Notwithstanding your optimism about the future of the economy and the strength of Basel III and the Volcker rule and all the rest, just to be a realist, the question for you is, what do you think would happen today if one of the 5 largest banks in America failed again?
Well, I actually think if you take the top 5 banks, maybe, I think they have, already America has, by this recapitalization, by the CCAR experience that they just went through, I think America has done a terrific job in recapitalizing the banks. And so I believe that and some of the powers that Dodd-Frank gave the regulators, I think they could probably now find a way through a crisis that it would not come back. And so I think, in some sense, my frustration is American bankers are being dragged into that rather than saying, let's get there, and let's get there as fast as we can. And then I would think it would give them moral ammunition to say, But like, why do I need all these micro regulations that have nothing to do with safety and soundness? And so I do actually think America's banking system is pretty strong. I would not say the same about Europe. Hi, how are you?
Fine, thank you. Just a specific question. Do you anticipate expanding your mortgage operations?
We do indeed. We're growing our mortgage business about 30% a year in the United States. I was meeting some analysts this morning, and one of them said, well, I have to tell you, I can't believe I walked across the street from my bank to your bank and I got a mortgage, 24 hours, and couldn't believe the difference in the service. So this is a potential huge area of growth for us. Frankly, the mortgage market remains a disruptive market in the United States, and if you're a new entrant, disruptive markets are good markets, and so you're able to get top quality mortgages at good margins, and yet because we're built around service, we can do it and it's a great experience for the customer. So 30% growth a year is not bad.
The left.
Thank you for coming this afternoon. You said earlier in your comments that you were committed to employment in the U.S. and to this region. I'm wondering if you anticipate growing your employee base here in Massachusetts, though.
We would love to. I'm saying the mayor, if you can find me 10 more sites in Boston, we'll do 10 more stores in Boston next year. So literally our only constraint is that, finding good sites and getting them in Boston is a constraint. If I can tell you our New York City story, Commerce Bank, which was our predecessor bank, entered New York City as in first branch at the end of 2001. Today, with our growth that we've been putting in, without buying a single bank, without buying a single branch, we are now the 5th largest bank in New York, and we will be the 3rd largest in 2016. From how many organic growth stories could tell you that story? We would love to do exactly the same in Boston. It's just how fast we can find sites to grow those stores.
Okay, the mayor's ready to go on that, as always. he gets going. So thank you, Ed. And it's time for
he's got one more question.
We'll squeeze it in because you're user-friendly at TD.
Thank you. I just had a quick question that I'm pretty sure, I could be wrong, that there will be a financial explosion sometime in the future, 10 years, 20 years, whatever. And the government will make a statement that the real economy is going to get affected and step in. Because there's no way in the world to understand that will the real economy get affected or not. So I think that, why change anything? Because these things are going to happen, and nobody can make a statement that the real economy is not going to get affected and the governments will step in. So I don't foresee any, kind of a solution that's going to take rid of everything and it'll be a beautiful new world and nice world to live in. I do hear your point that bankers, if they stick to what good old-fashioned banking is, the world will be different, but I don't think that's ever going to happen. There will be humans who will be greedy and dishonest. That, I don't think we will be better moral individuals tomorrow. I don't think so. I could be wrong.
Yeah, so let me be quick. You can't rule out business cycles. You can't rule out having financial ups and downs. The issue is what's the consequence of that. In this case, what we did was we brought down essentially the fiscal strength of governments around the world. The claims on governments were so massive. Ireland, Iceland, even in places like the UK, the effects were dramatic. They do not have to be that. I mean, Canada had we've had financial crisis in Canada, but we've never had to bring the government of Canada down in order to solve those financial crises. It's if you take a look at the dot-com, 2000, you had a huge implosion in the dot-com. Why didn't that bring America to its knees? Well, because the shareholders paid the price of that, not the taxpayers. And so I think you have to build a financial system where the financial industry say, I am going to run my bank in a way that I will never be bailed out by governments ever. But it doesn't mean you won't have banks go up and down in that. There won't be cycles in the economy, but they do not have to be as devastating as the last one.
Thank you very much.